84 units, apartment units, worth $14 million with no partners, no joint venture partners. Still, well, of course, that was some serious fast growth, leading to deleveraging, having to get rid of some properties that had high expensive mortgages with Kellan James. Greetings, my fellow Canadian real estate investors and realtors. This is the Truth About Real Estate Investing show for Canadians, the number 81 ranked business podcast in the world per Apple iTunes. Who knew a little podcast that started from the guest room in my home office, in my home, interviewing successful entrepreneurs in the real estate investment industry, asking them about their strategies, tips, tricks, what works and didn't work, getting to the details, the numbers, telling it like it is. For example, best deals often come from ugly properties, and in today's market, especially today's market. Today we have guest Kellan James. He's going to be sharing how, honestly, how there's very little operating cash flow, even in the apartment building investing space. We are not here to candy coat what real estate investing businesses are really like. We're not here to lie to you about the realities and challenges, but rather allow you, the listener, to leverage our collective experiences so that you may learn from our guests and my own experiences from operating a real estate investment business of buying, renovating, refinancing, repeating, sometimes just borrowing, buy and hold, and eventually sometimes selling income properties. Today, our guest is sharing his experiences in owning a portfolio of small apartment buildings in London, Ontario. Again, like I mentioned, he grew very quickly without joint venture partners, so no outside capital or credit. But before we get into that, I want to say Happy Father's Day to all the men out there who act like men and are good fathers to their children and grandchildren. Double shout out to the single moms out there pulling double duty. You are amazing, and I hope your children all spoiled you. Shout out to my own dad, who I will forever be grateful for leaving the tropical climate of Hong Kong, where they've never seen snow. Hong Kong, China. For those who don't know, Hong Kong is very much like China these days. And I'm very thankful to have been raised in the Toronto area. Thank you to my dad for coming to Canada, coming to Toronto for a better opportunity, and which led to a pretty great life for my brother and I. Being born Canadian is like winning the lottery. My daughter, our eldest child, made me a lovely card with a handwritten note that was extremely thoughtful. My son, the youngest, who unfortunately inherited many of my worst traits, as in he's not the most thoughtful. He didn't give me anything, but he did join me at the driving range. His presence is present enough. He joined me at the driving range on Sunday morning of Father's Day at 7 a.m. so I could hit some balls. He hit some balls. I do find it hilarious how my daughter is extremely thoughtful and helpful, like just like my wife. My son only helps me out around the house when asked to. And when he comes home from school, when he enters the house, he leaves a trail from the door of in order. One shoe and then the other shoe, a jacket, a hat, a backpack, a lunch bag, water bottle, socks, etc. He's the reason. He's a lot like me, hence the reason we need a nanny. Back to the golf thing. My son's only 7, so he's not super patient, but he was not patient enough to play 9 holes with me, with the old man. But we do enjoy our time together out in nature, doing something fun together. For the main event of Father's Day, we hosted my brother's family, my dad, my brother's in-laws for a pool party in our backyard, and I smoked a ridiculous amount of meat. With steak prices through the roof and my love of smoked brisket, I finally tried smoking a whole 14-pound brisket from Costco. I made a homemade rub. I smoked the brisket on low from 10 p.m. Saturday night till about 7 a.m. Sunday. I wrapped it and baked it another 3 hours on low, let it rest for 30 minutes and served. My dad and brother are foodies. They said the brisket was as good as any restaurant, and everyone was sent home with a doggy bag. As you can guess, 14 pounds of brisket goes a long way. Just guess what Cherry and I are having for lunch today. For those interested, I've included a link in the show notes for a link to the recipe to how to smoke a brisket. Also, shout out to all the dads and parents out who have invested or are planning to invest in real estate, so their kids may actually afford a house. This market, as I predicted years ago, maybe not predicted, but I knew there was a risk of. The risk that only the children of homeowners will be able to afford a home in this market, preferably I think most parents want their kids to buy a home near themselves. Quick story. One of my clients, their child, their partner is from the States, a southern state, and to ensure that that their child stayed local and that their grandchild would stay local, they bought them a house locally. That can only be done if you've made the right steps to prepare for this environment. Of course, those with multiple smart income properties have set themselves up properly for intergenerational wealth. I do say smart income properties, as we know, not all income properties are built equally. I give a presentation to some of Cherry's accounting clients on the weekend on investment trends. One trend is that with the interest rates are currently high, based on more recent history. It is, I know in the big picture, they're really not that high, but talk to some Canadians. I don't think they'll agree with that. They're feeling the pain. So interest rates are expected to remain at the current rates for about 12 months or so. And we'll see more sellers due to higher renewal rates, which of course will be more expensive. And investors will be divesting what they no longer want to hold. Those holding pre-construction in small markets face the most challenges, as demand in those markets are quite low. Many investors with single-family homes, including some condos and pre-construction condos, are selling or they're considering selling due to negative cash flow. I know several condo investors who are bleeding over $1,000 a month per condo. Thankfully, our clients, they own very, very few condos. I think I can count on both hands how many condos my clients own for that are income properties. So generally our clientele, we do have over 350 clients who generally, the vast majority of our clients own houses on land. So they're in very good financial position. Some are even selling those single family homes to pay down personal debts or even rotate that capital into something that could be a small multifamily. If you, one of our 17 listeners, is considering selling, please do consider my team and I to help. I've been a licensed realtor since 2010. That's a long time. I have all the gray hair to prove it. Our team has won Realtor of the Year 4 times. And in 2022, our listings, so the properties that we sold on represented our clients to sell, we sold them for 19% higher than comparable properties, largely thanks to a lot of hard work, hustle, and our commitment to excellence. If you're interested, email us at iwin, IWIN, at infinitywealth.ca. Again, that's iwin@infinitywealth.ca. And one of my coaches or myself will get back to you. For those looking to begin their investment journey, to invest, you need to own. So the timing couldn't be better to be a buyer. Motivated sellers are coming online, and we probably have about a 12-month window till that first interest rate cut. And all the buyers sitting on the sidelines, well, you better believe an interest rate cut will trigger many of them to re-enter the market, and then we'll start seeing a more significant next leg up in the real estate prices. If you're looking for a professional service provider who can help you maximize returns on your investments, time and effort, we can show you how at our next free training webinar or one of our iWin Mastermind tours where we go on site, very hands-on learning. Or if you're ready to take action, just simply email us at iwin@infinitywealth.ca. Our track record speaks for itself. For fun, I did look up what properties our clients were invested in 10 years ago. Their returns averaged 800%, 800% return on investment over those 10 years on the income properties that we help them acquire. Past never predicts the future, but for the majority of our clients, we here at iWin Real Estate have helped them create a portfolio of income properties that will help them retire comfortably and help them retire more than any other pension or RSP or savings plan. And nothing can make me happier except to provide the same service to even more hardworking, kind people who enjoy working with professionals like our team and invest in real estate as a side hustle. To the beginners out there, you are more than welcome to reach out. That brings us to today's guest, Kellan James, who was recommended for this podcast by my wife's team at Real Estate Tax Tips. You see accountants like my wife, Cherry, they know who the successful real estate investors are. They know who's actually making money. Hence, Kellan is our guest today. Kellan has successfully transitioned out of his corporate job. His timing for his explosive growth of his portfolio was extremely well timed. His deals were profitable and well executed, including his more recent deleveraging stage of his by consolidating his portfolio, paying off those more expensive private mortgages to manage cash flow. Kellan shares how his journey started, which was not that long ago. Kellan's been at this for, I think, about a decade or so. Again, that's pretty good timing. Same with the timing of his deleveraging. He talks about his story, how he started, the importance of coaching early on. He stays in touch with a group of 13 real estate friends to support one another. Kellan shares how he proceeded to grow both his portfolio and coaching business too fast, leading unfortunately to burnout. Thank you to Kellan for being so honest. I invited Kellan onto the show over a year ago, but I caught him during his social media blackout period, as again he had burnt out, so he was in recovery mode, and he was focusing on fixing his portfolio up, and he's here today to share the ups and downs, the realities of becoming a full-time real estate investor. You can follow Kellan at kellanjames.ca or on his Instagram, kellan.james. So please enjoy a Truth About Real Estate Investing show. Hi, Kellan. What's keeping you busy these days?
Hey, yeah, just this last while I've been just in a stabilization period with my portfolio. So I've had in 2021, I actually sold 5 buildings, which was 15 units, and then I bought 51. So I kind of transitioned from some smaller multifamilies, like 2 to 4 units, and I kind of got more into some of the apartment buildings. So, this last while I've been doing a lot of turnovers and stabilizing the portfolio. When you do that many acquisitions at the same time, there's a lot to be stabilized at that point. A lot of units to turn over and get rents up, and just kind of build that foundation before I build the building any taller.
Can you give us an example of can you walk us through some of the numbers on a recent acquisition?
Yeah, there was one that went really well. It ended up being one of my best BRRRRs ever, probably my best. It was this is going to be off the top of my head, but I bought an 8-plex. Everything I own is in London, Ontario. At this point, I have 83 units, solely owned, no joint venture partners. And this 8-plex I picked up in I think it was late 2021. And it was a seller that I had been in contact with off market for 6 months, trying to convince them to sell it to me off market. I bought another 8-plex off of them off market. This could be public knowledge, really. This was the Zafman family, the Z Group. So they owned tons of properties in London. So I was in touch with them off market, trying to get deals done. I got one done off market with them, and they decided, they got in touch with a broker, and the broker said, let's put all of this on the market and see what happens. So after a lot of back and forth, they decided they're going to hit the market. This 8-plex, they listed it extremely low, and yet for some reason, I know the reasons, but there was just not much interest in it. They kind of flooded the market all at once with all these buildings. So anyone who was in that space, the medium-sized apartment buildings, like 6 to 24 unit type stuff, they had already kind of picked through some of the other buildings, and this 8-plex was sitting there, and they didn't have any photos, and it said bulk metering, so you didn't think that there was any separate meters. And so I took a look at it. It was actually right across the street from one of my other triplexes, and they listed this 8-plex for $750, which in London is already an incredible price. But I put an offer in for $600, and they just accepted it. There was no back and forth, and it was actually because I'd already bought a couple other buildings from them, so they knew I was a legitimate buyer. They were kind of at their wits' end with trying to sell, I don't know what it was, something like 1,000 units or something ridiculous in London. So this was one of the remaining ones they wanted to just get rid of. And the broker's like, this is a legitimate buyer. Let's just take this deal. And I worked directly with the listing agent. So maybe there was some, double ending incentive there. And they accepted my offer for 600. So you can imagine in London, 200,000 a unit is not rare. 200,000 plus a unit is quite common. So I bought it for well under 100,000, and we actually ended up paying. So it came with 2 vacant units. It was 9 separate hydrometers, which none of the listing didn't have any of this information. and it's a 100-foot by 200-foot lot, pretty close to downtown. It's in a rougher neighborhood. It's in Soho in London, Ontario. But a huge lot with maybe some development potential as well. And I ended up getting all 8 units vacant. So two of the units were already vacant, and the other 6 we did cash for keys. I had to do quite a bit of cash for keys. Some of them I paid upwards of 10 grand. There was a couple of people I'd paid 10 grand. Some of the others were a little bit less, but towards the end, the people that are kind of sticking around for a while paid a little more. And so we had all units vacant. We were able to get in there. It was a massive renovation, probably upwards. It was, well, I mean, we'll see when my taxes are completed. I haven't added it all up, but it was something probably upwards of maybe 400,000 in renos. New metal roof and all the units renovated. And they're all 1-bedroom apartments. So we ended up getting them all fully rented at market rent. I think we got like $1,250 for most of them, and I think $1,150 for the basement 1-beds, all plus hydro, and it reappraised at 1.75. So I was in for $1 million, and it got it reappraised to 1.75. So I was super happy about that. And this was right in the middle of when interest rates and stuff were all starting to get pretty high, and loan to values on refinances started to suck. But luckily, even with this one, I think I got a 55% loan to value on the refinance, just because they're just being so stingy with mortgages. And this was with a credit union, and it still was a perfect BRRRR, even at 55% loan to value. So I'm super happy with how that project worked out. Now it's got 8 good tenants, and we're actually in the process of doing a pre-application with the city, because this lot is huge. It's almost like a soccer field in the backyard. It's this huge grass field, and we have a pre-application in to maybe build a 12-plex on the grass on the land behind the property without having to tear down the 8-plex. So we'll see how that goes. It's in the extremely early stages, but it could turn out to be my best deal ever, especially with some decent size to it.
Much to unpack.
Yeah.
The show's called The Truth About Real Estate Investing, so I have trouble with filtering myself, but it sounds like the agent did you a favor. Not so much the seller.
Well, I mean, I worked with them I worked with them quite a bit.
Wait, they didn't even counter. They just took it.
They just took it. Yeah. Yeah. They were like, this is a legitimate buyer. He's bought a couple other buildings from you guys already. You guys should just take it. And I mean, I added it up, and I think the portfolio that I bought an 8-unit, I bought 2 8-plexes, a 24-unit, an 11-unit, all off of the same people, same broker. And and I think it was like 80 grand in commissions or something, just from just the 2% or whatever, and that was when I went, man, should you call the listing agent? Should you use your own, your own agent? Should you get your realtor license to get that $80,000 check yourself for these acquisitions? It's a bit of a debate back and forth, but sometimes it helps, I think, to work directly with the listing agent. But I mean, God, I know that's a gray area, but luckily I'm not a realtor, so I can talk about it.
That's the thing as well, because being a realtor, you get really handcuffed in a lot of things.
Yeah, exactly. I've specifically not gotten my realtor license over the years. When you're trying to buy stuff off market, having to disclose that you're a realtor, and people get all of a sudden, oh, they're going to take advantage. And, I like to just be a buyer, oh, I'm looking to buy a house, looking to buy an investment property. They don't feel like they're being taken advantage of, whereas if you're a realtor, all of a sudden they feel that way. So
right. They just get their backs up because.
Yeah, exactly.
I think realtors down there with used car salesmen in terms of and politicians. It's not trust.
Yeah, exactly. Trust is not there, so that's a huge part of it. If I'm dealing with people, it's nice to just say I'm just a grassroots investor. Like I'm, just trying to buy an investment property or whatever. And I was never big into wholesaling. I've done a couple of wholesales over the years. When I find a deal that's just not for me, I pass it along to a fellow investor. But same thing there. Like if you're a wholesaler, that's why you see a lot of wholesale company or wholesale businesses having a realtor on board, but not the one that's doing the negotiations necessarily. And people getting in all sorts of gray areas. But I like to not be a realtor as of now. Although, like, I look at my portfolio and go, man, at some point, 20 years from now, I'm probably gonna sell this, and it's kind of nice to get the commission checks on the sales of this entire portfolio because my portfolio is over 13 million as of today. So the commission check would be nice to pay myself.
Do you think you'll actually divest your portfolio?
I don't know what 20 my plan is to hold for 20 years. You never like no one ever knows what 20 years holds. But that's yeah, I've never thought about the idea of passing it on to kids and stuff like that. Who knows what that'll look like? I really don't think I can plan that far ahead. But I think that the reality is probably at some point I would sell things off. I've seen what it looks like when people try to pass properties down. The Z Group stuff was a decent example that I bought a lot of their stuff, and the original founders of the company and like the son, like they were running the business, and then it sort of once they passed away, things weren't really being managed the way they should have been, and I don't know, not really a lot to be said for your legacy, for your legacy if things just get run down once you're gone, right? So I kind of like the idea of yeah, bringing buildings to their best use, holding on to them, maintaining them well for a long time, and with the idea that at some point I probably would let things go. At that point, I'm sure there'd be millions of dollars in capital gains tax to pay, but it'd be totally
BTBs.
worth it because it'd be exactly at that point it's irrelevant, right?
Yeah. Well, you just get paid in VTB and then
Yeah,
spread
yeah,
it out.
yeah, exactly. And if I'm still well connected in the space 20 years from now, then there's probably plenty of investors that could do some kind of creative financing with like that and find some win-wins. So yeah.
It'd be funny. Like, I want a VTB. Whoever's behind
Yeah,
me
exactly.
must pay me. And these are
Yeah.
my terms.
Yeah. I've had sellers that I've tried to buy properties off of that are like, I want to do a VTB. Like I explained it to them. Oh, that sounds good. Like I definitely want to do that. And like, yeah, they end up, they end up like, they're like, and I've had some like, we want it to be interest only. Like we want to know that every penny of the payment is interest. Like, there's no principal pay down. I'm like, perfect. That's what I want too.
Right.
Yeah.
What kind of terms have you seen for VTBs?
I haven't. So it's funny. I've actually never done a VTB, which is kind of crazy because I've negotiated quite a few, and then just didn't end up taking on the deals or passed along to somebody else. But so I'm not even too familiar recently. But I generally like to do interest only. Like if I was to do a VTB, I'd want it to be interest only. I would want it to be with a lower down payment than what I'd get if I were to go to a bank or credit union. And those two things would be enough for me to justify, going with a VTB versus going with the bank. But to be honest, like rarely have I found the VTB terms, at least in first position VTB terms, for them to be better than what I'd get at a bank anyway. So a lot of times I just go with the bank, especially like the first 10 properties. I was just going with Scotia Bank and the rates were super low. And it's like, why would I go elsewhere, and then like with second position stuff, you can get pretty quickly in like as an investor, if you want, you can borrow. Generally, you can borrow as much money as you want. You can get as high leverage as you like to, and we tend to glorify in this. A lot of people tend to glorify in the space raising capital. But I feel like raising capital is something that is almost the default, and you kind of need to stop yourself from raising capital. So, when it comes to like getting a bunch of second position VTBs and things like that, like at some point we need to say like how leveraged do we want to be, and how exposed to the market do we want to be? Like we all want to have some degree of exposure, and we want to ride the market as it goes up over the long term. But like we have to understand that when the market goes down, that we're riding it all the same, and the more leveraged we are, the more we're affected by it in either direction. So I like to maintain somewhat reasonable loan to values in my portfolio, and if I take on too many VTBs and second position stuff and private loans and too much of that, things can get out of hand pretty quickly.
Right. So for the deal that we're discussing, like you mentioned that the credit union gave you 55% loan to value. So are there any other debt tied to this property?
No, I still just have it at 55% loan to value, and I've moved on. I mean, I could bring it to CMHC or something. There'd be a ton of capital to pull out if I were to do something like that. But I'd like to have some degree of like safety net in my portfolio. I alluded to it earlier, but I like the idea that like if you're building a tall building, you build the foundation differently. And so I'm really trying to build a large portfolio over a long period of time. And for me, I need to have a nice solid foundation. So I could scale faster, but then I end up with a tipsy building. So
Yeah.
um, that's sort of been my mentality. It's a lot of also why I invest with no joint venture partners, and just I have full control over things. I can choose when I want to, if I need to sell something or what type of renovations I want to do, and I don't ever feel like there's no shotgun clauses or anything where all of a sudden we need to, like, you need to buy it or I need to buy it or we need to sell it, or I like to know that I can think long term with all of my decisions. Yeah.
That's pretty cool because I literally spoke to an investor last week who took a course, and in the course they were instructed to use their personal lines of credit to finance the renovations.
Yeah. Yeah. I mean,
That's like the opposite of what you're talking about.
like, I'll be honest, I've done that myself. Like, I have personal lines of credit. You get like a $20,000 line of credit with TD or Scotia, and like, you know, if you have some degree of predictability with the BRRRR and you see the ARVs there, like, I don't think personally I'd be okay with temporarily leveraging like that. But there has to be a very clear exit plan. Like, the plan isn't to hold those lines of credit maxed out for years, right?
Mm-hmm.
So I've done a decent amount of that, and I've done like private loans and stuff. I've done the promissory note stuff,
Mm-hmm.
but like, I've also learned a lot of lessons in that space. We've seen a lot of examples where that can get out of hand, and about a year ago, even myself, I went, like, these loan to values I'm getting on the refis aren't what I wanted them to be. So I don't have as much as I'd expected to have had to pay out these private loans. And then I went, well, this doesn't play out well long term, and it doesn't play out well at scale. I mean, actually, it could play out well long term. You can always borrow from Peter to pay Paul, and that sort of thing, but and ride it out and wait for the market to save you. But I've never been the type to do that. So, that was why even myself, this last year, I did all the refis I could, and then I sold a couple. I sold a duplex and a triplex, and I took I don't know, hundreds of thousands, and I just paid off private loans. And I just wanted to just be in a place where I'm never like, oh, the news came out and it's going to affect how my life looks now. Like, no, I want to know that I'm in a place where things can happen and I'm fine, and so this last while has been like, I deleveraged and I've been stabilizing, because I don't know, I wasn't comfortable with how things look at 5, 6, 7% interest on these mortgages, and additional private loans on top of it. So yeah, just like deleveraged and kind of got myself back into a safe position, or what I consider to be safe. I'm a relatively conservative investor, so yeah.
Seems
So,
that there's few of us out there.
Yeah,
At least
yeah.
what you see on social media.
Yeah, I mean, people see, like myself, like, in my first 2.5 years, I could tell my story, I guess, from the beginning. So I did computer science in school. I paid my way through school myself. I lived at home, but I paid for my school. Um, and and then I worked for 5 years. I graduated in 2012, and then I guess in 2016, late 2016, I bought my first duplex. I'd saved up 120,000, including my RSPs and all that stuff, and just lived super frugally. I sold my car and walked to work and saved every penny I could, and took the 120 grand, and I actually pulled money out of my RSPs and the home buyers plan. I bought the place with 5% down, and lived for free, and then kind of moved on to the next BRRRR projects from there. And everything after that was 20% down, the Scotia Bank. And in 2.5 years, I got to 10 properties, 32 units. So that was fast scaling, right? So a lot of people see that and want to sort of emulate that, but you have to get some unicorn deals to scale at that rate, especially without partners. Things need to, like, be really good BRRRRs. You're getting all your money back and more, and things like that, because otherwise you run out of money, and then the only way to buy the next deal is to bring on a partner or borrow a bunch of money. And I didn't want to do that. So I've always been focused on maintaining momentum of my own money. So everyone talks about your other people's money. I like to talk about your own money, because I feel like that's a way to scale safely, and it kind of forces you to do better deals. Because if the deals are good, then you get your own money out. You get all your money out. Why would you involve a partner anyway? It's just going to be the same amount of work for half the result, or you got to do twice the number of deals for the exact same result. Or if you have two partners, now you got to do 3 times the number of deals. And like at this point, I'd rather own my 83 units than like 166 units with a partner. 100 times over, I'd rather have the situation I've built. So it's just nice to know that, if I have decisions to make in my portfolio, that, I don't need to run them by anybody, and I can trust that, well, any of the results that I do get are my own, and any mistakes that I make, I have to take the consequences. So it's just full accountability. And you can sort of build in like that sense of partnership with your property management team and with your GC and things like that. I actually feel a lot of that, good vibes that you get from partnerships, or a good partnership without the equity stake. I have that with my property managers. They want to turn units over too, and they want to get rents up because they're going to get more, they're going to get paid more as well. And, they're in this for the long term with me. Yeah. So it's really nice to kind of have
too. Right?
Yeah, exactly. Better tenants for sure. Yeah. So, I got a text from
less work.
Yep. I got a text from my property manager just yesterday. Like, when are you buying the next like crazy building? Because I buy a lot of crappy buildings and make them nice, right? So it's just like, it's awesome to have that, like, they're on the same team, but they're making money in their own way, and it doesn't have to be in the form of equity on my properties.
Yeah, that's what people need to remember. There's partners that we can hire.
Yeah,
pay
exactly.
a wage to. We don't have to give up equity necessarily.
Exactly.
Right?
Yeah.
That's what I say to my clients all the time. Like, oh, I want to JV with this person. Like, you can hire a really good property manager.
Yeah. Or like, oh, I have a friend that's a contractor. They'll be my partner on this deal. It's like, you can hire contractors. Like,
yeah, that's what I literally told that to somebody. They're really good, eh? Why not just hire them?
Yeah, exactly. Yeah. Well, they'd really like an equity stake in the building. I wonder why. Like, I was like, for my like first few years, I was before I like kind of branded myself, I suppose, as the guy who invested without partners, because I did a talk at Onria, Sean Allen and Jen Bodring's event, some years back. Matt Pichet was there talking about building a portfolio of joint venture partners. And then I went up and talked about building a portfolio without joint venture partners. Mm-hmm. And it's just, that was because I was like, well, what am I going to talk about? It's got to be something different than what everyone's talking about. And everyone's talking about BRRRRing. It's like, well, I'm going to talk about this. And then I realized it kind of stuck after that. Mm-hmm. A lot of people resonated with the idea of it. I always thought it was the default, right? I always thought that's how people build portfolios, isn't it? But then, I realized it ended up becoming a niche, I suppose. Which I never would have considered, building your own portfolio a niche.
I have a question I'm going to guess no one's asked you. So as for listeners' benefit, no one gets their questions in advance, because I didn't know I was going to ask you this. How many unicorn properties do you think you have in your portfolio? Past and present?
It's a good question. My second property I ever bought was a unicorn. I paid $127,000 for a duplex, and within 4 months I had it reappraised at $250,000. I was only in for $150,000, and it reappraised at $250,000. I have a sixplex that I bought for $365,000. This was years ago as well, but even still, at the time, a sixplex would have been worth, I don't know, like probably at least double that, But it was a crack house. Like, it really needed a lot of work, for lack of a better word. I mean, there were people like cooking on spoons on the stove. So,
I'll assume that's crack. I have no idea. So
I don't even know.
Maybe the listener can let us know if that was crack or not, or something else.
Let me think. This eightplex, I think, was a bit of a unicorn, I would say, that I just did.
I'd agree on the eightplex.
What's that?
I'd agree on your recent eightplex. That's a unicorn.
Yeah. Let's see. Like, I think there'd be varying degrees of what people consider a unicorn. Like, I would say that like 70% of my deals, if anyone saw them, they would have done. Like, so that's probably a decent.
I don't know. I don't know if many people can walk into a crack house and say, I'm buying this.
Yeah, true. Maybe that one wouldn't be. Yeah, that one's maybe not a good example. There was a triplex I bought for $147,000, and it reappraised at like $400,000 not long after. But I had to put about $100,000 into that one. But I suppose if people saw if people saw what these properties could become and what they are now, and they're willing to put the work in, like, I think then at that point anyone would do it. I'm trying to think. Like,
let's just go stay on this triplex. What was the story there? What made it? Was it an ugly property?
Super ugly. It looked like a shack. I always say we, but it's been me and my contractors basically. But yeah, they had listed it for 150, and again, I don't know how, or no, sorry, they listed it. I don't know, I don't remember, maybe 170 or something like that. I went in at I ended up getting it for 147. I know people that walked through it, and then when they found out that I bought it for that price, they were like, "Oh my god, like that's so cheap! I didn't
All
know
right.
that you could negotiate it like that." But it looked horrible from the outside. It had like wood siding, and I don't know, it was awful looking.
Yeah, wood side
And
is not treated, if not cared for.
Yeah,
Looks
and it
wood
had
wood
foundation.
does
It
not
had
do well over years if it's not
no,
treated.
no, exactly. And it had like joists, like the joists were all like bowing and stuff. Like it was really really rough in the basement. Um, and it didn't have a lot of parking as well. It only had a couple of it had two parking spaces for three units, which isn't ideal. But yeah, I went in, I asked the seller, can you provide vacant possession? They said no, but we can ask the tenants if they want to move. And they just put in a letter and said, the new owner was asking if this unit can be vacant on the closing date. And it wasn't like a landlord tenant form or anything like that. It was just a request. And two of the units were vacant on closing. And then the third unit, the tenant was out a month later because they were just in the process of moving. So I think that was a bit of a unicorn. Like, I can't believe I got it vacant without any guarantee of it. So we put all new siding on it and a new roof, and it looks really nice from the outside now. And I ended up buying the property across the street is the eightplex I just referred to. It's got all the parking in the world. So now I get to share parking with that building. So yeah, that was sort of a unicorn deal as well. I've had I had a student rental once that I got a pretty good deal on. It sat on the market for a while, and I think they had it listed at like 300, or sorry, yeah, 300 at the time, and it was a four bed in the front and a bachelor in the rear, and this was some years ago, so it wasn't like, it was a pretty good price still, but I went in at 250, and they were negotiating back and forth, and I just kept holding at 250, and eventually they just accepted 250. And then I told people I got it for 250, and they went, "How did you get that for 250?" It's like, I negotiated on it. But it was funny, that property, they listed it, I think, at 275, at 250, and had a lot of people interested. And then they relisted it at 275 because they had too many people interested. And then no one was interested because they relisted it too high. And then I still stuck at my 250 price. I think that was something like that. Yeah. Yeah.
So I'm going to apologize to the investor that we're rehashing a lot of the past because a lot of these prices aren't available today.
No. Yeah. I mean, if we can talk about the eightplex again, I bought it in late 2021. I mean, maybe a year and a half ago. It wasn't that long ago. And that was 600 grand. So like there's just been deals and deals over the years that, people look back and they look at the price and go, that sounds completely ridiculous. But you can imagine this eightplex is a decent example of how I think anyone, if they would have seen the potential in this property, would have paid 600 grand for this eightplex, but it was sitting on the market, sat for a month, and no one bought it. So, I mean, I've found unicorn deals both on and off market. Yeah.
Before you asked me what I was doing before this morning, before this call, I was saying how I was writing a post about new construction, pre-construction, and of my portfolio, I've only ever bought pre-construction once. And this plays into the unicorn discussion, right? And
Yeah.
I paid $275 for a 5-bedroom student rental in Brantford.
Yeah.
Right, that was quite a few years ago now, and that property's worth probably $600,000 now.
Nice. Yeah.
So I'm just thinking about my own portfolio. I think time has made a lot of my properties winners.
For sure.
I don't know if anyone would call them. Everyone's criteria for unicorn would be different.
Yeah.
But
I like to think
time has really helped out.
Oh, 100%. I like to think of the unicorn deals as stuff that I got turned over and reappraised within 4 to 12 months, So a lot of these, like this second duplex, took 4 months for me to bring it from the 127,000 I bought it at. I put 25 in, so I was in for a little over 150, and it reappraised 250. So that was 4 months. And I like to think, like, it's for me, I've always focused on forcing appreciation. It's the only thing we have control over.
Mm-hmm.
There's a resonating theme in my portfolio, and it's all about everything that I'm trying to keep within my control.
Mm-hmm.
No partners and all of that. So yeah, the unicorn deals that I liked are the ones that really made sense within it 4 to 12 months. But everything turned into a unicorn when the market did what it did. But it's nice that like the market went up as much as it did in say 2020, and it's dropped a decent amount this last while, but nowhere near what it went up. So while things are still extremely unaffordable for people trying to buy, on paper, people seem to be still doing all right equity wise if they bought well.
It actually leads me to a good question. I think it's a good question because I'm just naturally curious. Like, if they take the Eplex, for example, how did you capitalize it? Like, where'd the down payment come from? We're using like, is this just refi money or is this cash?
This was refi. It's at that time I bought the 51 units, right? So it was a combination of refinance funds and prom notes. I borrowed some money. That was my lesson learned, is I got too leveraged during that time. And that's why I talked about the deleveraging stage that I went through. So good lesson. But yeah, a combination of refinance funds and some borrowed funds for those 51 units that I acquired. Because I bought a 24 unit that was over $1 million down payment. So without a partner, that's crazy. Crazy to come up with. But yeah, I bought it with Libro Credit Union actually, and it was so 25% down. And I had no problem appraising. I think it appraised immediately for 7 or 750 when I bought it for 600. So a lot of money was made on the buy, and then it reappraised, set at 1.75, but I only got the 55% loan to value. So I could probably bring it to there are other lenders now that I've found that would give me a better loan to value, but I locked in at a half. I think I got a 4.9 or something on the interest rate. So I might hang on to just that loan for a while, but there's a lot of equity to still be pulled out of that property. And I would feel half decent about putting a second on it, because I could put a second on it and bring it up to say like 70% loan to value. It's still not over leveraged, but just trying to make sure that I maintain that lesson learned this last while. You can't leverage and deleverage at the same time. And so I've been in the deleveraging stage, and so therefore I haven't been in an acquisition phase quite as much. I'm expecting to re-enter one in about say 6 to 8 months if all goes well. But we're just still on a cash for keys blitz, turning units over. I've probably turned 20 units over in the last year and a half. So just paying a lot of people to leave and turning units over and getting rents up, because that's the most valuable thing we can do as investors. And I think there's a very strong case for Canada to be a country of renters in the long run. And there's going to be a lot of tenants that will never leave. There's plenty of tenants in my portfolio that will probably not leave no matter how much I pay them. And I think that decision will become easier and easier for them as the years go on, if they're locked in at the rates they're locked in at. And who knows what happens with, I'm not going to get into politics, but who knows what happens with all that. So, while we have the option to do what we're doing, I'm going to continue.
No,
I just saw some like
not allowed to
NDP
compensate your tenant for leaving.
Yeah, exactly.
Bad. That's
Yeah.
so horrible that you're giving them money.
Yeah, well, I mean, I saw an NDP proposal about like, units staying at the rent that they were with the previous tenant no matter what, and I just couldn't believe that was even a proposal. You'd end up with a country where people never renovate the units because they have no reason to. Like the reason the rents go up is because we make the units nicer. But
That's
otherwise they just get run down.
One comment about the NDP is that they have challenges raising money. I wonder why.
Yeah.
People with money don't want to give you money?
Yeah.
I wonder why.
And I don't follow politics almost at all. I haven't read a news article I don't follow any news. The closest I come to following any news is just whatever maybe you share on Instagram or like a few other people, right? But like that's basically it. I focus on what I have control over, and news. And I mean that was a part of like this. I went on the social media blackout there for over a year. And that was another part of it, right? Is just choosing what my inputs are. We all like to think that we can control what we think about, and but at the end of the day, it's sort of you're the average of the five. So you're the five people you're around, but also the five news sources or the five, I know, sources of information. And I don't know. I try to be pretty cautious about what I expose myself to. So same with books and things, right? Like, you can read a book like I've read like the 48 Laws of Power or 48 Laws of Power. Is that what it is? Like, and crazy book. It's all about like manipulating people and stuff. You got to be careful, what you expose yourself to. But at the same time, like, there's some degree of like mental resilience and like understanding that like, okay, like, well, there's people like that out there, and this way I understand it. And so there's some combination, I suppose, of like exposing yourself to things, but still maintaining conviction in your own beliefs. But then also, yeah, not going too crazy with it. Choosing what you want to expose yourself to.
If you have the appetite for it, I'd recommend Book of Influence by Robert Cialdini.
Okay, yeah.
I'm pretty sure every influencer has read it.
Oh, I haven't. What's it called?
Yeah. The Book of Influence by Robert Cialdini.
Book of Influence. Interesting.
I'll send you the link, and for the listener, yeah. I'd recommend you watch it too, because every politician, every marketer, advertiser, every good influencer that I see on social media, I'm likely they've read it, or whoever they're learning from has read it. Because I see people using that playbook very well.
Good to know. Yeah, good to recognize these things.
I recognize all the time, man.
Yeah. I mean, I think it's similar to like, you read books on negotiation and you go, oh, I've been using those things, right? And I think that people who tend to manipulate read these books and go, oh, perfect. Like, that's how I manipulate people. It's like, but like, I don't know, like for someone like myself, I read this, man, like, I didn't understand that this is how people's minds work. Like 48 Laws of Power is like, like don't outshine the master and things like that, right? Like if you're learning from someone, don't make yourself sound better than them, because then all of a sudden they'll recognize that you might try to take over their power. And it's like, wow, like I didn't, like you got to be careful, like as an influencer too, like the people reaching out to you, why are they reaching out? And the friends that are trying to befriend you, why are they trying to befriend you, right? Like, luckily I'm a pretty good judge of character. Met a lot of people over the years and networked with a lot of people, and now I generally know who is worth interacting with, and who's like, who I can learn from, and who's a genuine person. You can I can kind of get a drift of that pretty well these days.
And you live in London, so there's lots of opportunity to connect with people.
Yeah.
There's a lot of people of your generation that invest and live in London.
And I don't know how much of that we had an influence on. So like Matt McKeever was a mentor of mine in the early days, and we started London on Fire. We had people coming from all over, not just Ontario, but like we had people come from the States and flying in from like Western Canada. Like there was, myself, Jeff Weibo, Mike Rosehart. There was like a bunch of influencers that were really, it became a hub, London of all places. And there were no other meetups at that time, really. No other like grassroots, I suppose, like types of just networking events, meet up once a month. Like, so people were coming from all sorts of cities, and, and I think it really spawned something. Now every city has a meetup and this sort of stuff, but there's something about that. And it all came from some random post on Bigger Pockets in 2016. We all had alerts set for our city because that's how it worked on Bigger Pockets at the time. If anyone mentions London, Ontario, you'll get an alert. And a few of us got that alert because we had it set, and we had a meetup. Myself, Jeff Weibo, Matt McKeever, and a few other guys, and we started our own meetup. And kind of, I don't know. I'm never really sure how much of an influence that we had over things, but we had still a couple thousand people in that group, and we had like 50 people coming out every month. So it's yeah, and just a lot of social media stuff spawned off of it. So it's kind of cool to see. I don't know how much of an influence we had, but
a lot of those guys you mentioned have gone different directions. Are you still connected with any of them regularly?
Yeah. So like to some degree, I mean, Matt and I aren't just in touch as much this last while. He definitely went a different direction. Like he was getting into NFTs and Bitcoin and stuff like that, and a lot of politics. So it just wasn't what I was doing. So I just so we're in touch occasionally. But he's kind of doing his thing. I'm still in the real estate space, so I'm doing that. Uh, yeah, I have like a group of we have a group of 13 friends. We have like chat together. We tend to do a lot of our parties and group hangouts and stuff together. Most of us are basically all of us are real estate investors or business people of some kind, and I've kind of we found our tribe, I suppose. And it's neat actually. Three of us groups of friends, three of the couples in that group are getting married this year. So um, yeah, so it's gonna be a crazy year. But yeah, it's so important to get those people and I don't know, to like have people you trust around you that are like excited when you're doing things, but also like reeling you back in if you get too crazy with something, and just finding that healthy balance.
Right. Yeah, because you mentioned like you had a social media blackout.
Yeah.
Was there anything else going on? Was this during your deleveraging stage where you're just trying to focus in on your business?
This was so I started a coaching business, and it got big faster than I wanted it to. And so I took on too many students. I took on a lot of real estate deals. I got burnt out. That was at that point like 5 years of just sixth gear, just like full pedal to the metal. And I went, I guess I got burnt out. So I went, I think it'd be really healthy if I just stepped off of social media for a month was the plan.
Because you were a content creator, you were creating content like weekly or something.
Yeah, just like mostly Instagram, but I like sharing a lot of that stuff. I had some YouTube going on, and then I was doing a lot of coaching calls every week, and I just went, I need to take a break from a lot of this stuff. I'm going to continue scaling my portfolio, doing my thing, but let's take a break. So took a month off, and then went, I don't really feel like coming back, and turned into over a year. And during that time, we did a lot of travel. We went to we traveled with some friends. We went to Norway for a few weeks. We went to Australia for a month, New Zealand for a couple of weeks, Costa Rica, Dominican. We did a 1 month van trip. We have a Sprinter van, and we took this van, drove out to the Eastern Canada for a month. So I was doing a lot of travel and that sort of stuff during that time. So, and then I only really came back on social media this last, I don't know, few months. It's kind of when I got back into stuff again. So.
Right. But you're there to share content. You're not consuming so much.
Exactly. Yeah. The only content I consume is generally not a lot of real estate content. It's just like comedy and whatever, like philosophy, that sort of stuff. Like I love stoicism and stuff like that. So, but like content wise, when it comes to real estate, I mean, it's a challenge at this point. It sounds ridiculous. It sounds cocky, I suppose, but it's a challenge to find people I can learn from. They're out there, and I'm actively out. So I'm actively trying to find them. And I have found some, but social media is not a place that I can go really to learn for the most part at this point. So it's not really a useful use of my time. So
I saw a wonderful clip of Ryan Day on a late show. He summarized stoicism beautifully. I'll flip it to you over Instagram.
Yeah, no, I love Ryan Holiday, right? I've read a bunch of his books. Ego is the enemy, stillness is the key, obstacle is the way. I still need to read Discipline is Destiny. These have become like core philosophies for me at this point. I do something where on the locks or on the background of my phone, I have like a phrase or something that I really want to drill in and like once it becomes a core philosophy of mine, I put it on a Google Doc where I have a list of my core philosophies. And I look back at those and like all of those things that's how I live my life now. So like one of them for a while was like, Warren Buffett said the difference between successful people and very successful people is that very successful people say no to almost everything. And there's a bunch of
lots.
Yeah, exactly. Yeah, I mean Tim Ferriss has said stuff similar. Yeah.
Tim Ferriss says no to almost every deal.
Yeah, you have to. And like, man, there's a lot of stuff to say no to out there. A lot of distractions, a lot of things preventing people from maintaining focus. So that's a core philosophy of mine now. And it wasn't like always, but there's been a few others that I've added to that list over the years. And Alex Hormozy's got some stuff I really like. So trying to drill some of those philosophies in right now as well.
I like the simple one. It's either hell yes or no.
Yeah. The hell yes. Yeah, that's a good one. That was a hard one. I didn't fully agree with it. I don't know, but I get it. I get the spirit of it for sure.
Well, someone like yourself, I'm sure you're invited to way too much stuff. We're invited to
For
invest
sure.
in too much stuff. So it's gotta
Yes.
be either a hell yes or it's a no.
Exactly. And I think it's like I think these come in waves. I think we have times where we're very busy, times where we're a little where things are slower, and I think when times are busy, it's time to say no to more, and when times are slower, it's time to say yes to more. People who are like depressed or whatever out there, like they probably well, if unless they're depressed because they're overworked, if they're depressed because they don't have enough going on in their lives or whatever, they need to start saying yes to more. They need to go out to groups and they need to like do new things and learn new things and
Yeah.
get out of the house and stuff.
Be more of service,
Yeah,
right?
yeah,
Everyone
yeah,
can find that opportunity. If you're feeling depressed, go be more of service.
yeah, yeah,
Go
and that
volunteer
requires
at a
saying
charity.
yes
Yeah.
to a few things, even if it doesn't feel like a hell yes. So I think I think that it's everyone needs a different message. I think
Mhm.
people who are overworked need to hear the hell yes or no thing.
Excellent. So, Kellen, we've covered a lot of real estate porn, as I call it.
Yeah, yeah,
Because the one thing I want the listener to understand is that the deals that you did, especially like the last one, you wouldn't have done without your reputation. That
right,
fair, right?
right. Yeah, yeah. I think confidence in my ability is a big one, and
Yeah.
then
Cash on
um,
hand, refi money on
yeah,
hand, right?
yeah, exactly. I mean, when you have a decent sized portfolio, at some point momentum gets built in. If you have 10 buildings, you refinance property number 10, you go back to property number one, and then property number two. Like there's always some availability of equity that you can take and put toward the next deal. So
Hmm.
once you've kind of got that portfolio, momentum is built in.
Right.
Um,
So I want to talk to the new investor. So you mentioned that you may even mentor investors one on one. So what do you tell a new investor today?
Yeah. So what I always focus on is people forcing appreciation because it's the only thing we have control over. So, the goal for many years was build a high cash flow portfolio, which is very difficult to do with current interest rates in a city that I feel comfortable in long term, right? There's plenty of like little towns or whatever you can invest in that might have high cash flow, but I personally don't have any interest in owning 100 units in some random town. So I think right now the sweet spot for new investors is going to be first off, one of the best ways to structure your first deal is with 5% down and using a purchase plus improvements mortgage. It allows you to get a building that might need some work, but still get it with only 5% down and also get the renovation money to put into that, and then house hack. So yeah, say a duplex with 5% down, purchase plus improvements, I think is the best way to start. It also means that the deal doesn't have to be quite as good because you're able to utilize some leverage and get a quality building and just break the ice.
Right. Well,
And then
also these people can't buy a nightmare like you've been buying.
no, exactly,
Because the
exactly.
bank will not touch it.
No, exactly. Yeah. So I think the next deals need to be significant value add though. So at that point, ideally something with some degree of predictability. So hopefully a unit or two is vacant, or at least it seems like the tenants might be willing to accept cash for keys, some kind of predictability, and very clear ability to add value and a reasonable conservative ARV so that if you're able to refinance, you don't have to leave too much money in the deal. Um, but I think that people need to realize if you're doing it without partners, you don't need to scale as fast. You can do half the number of deals. So if that's one property a year, great. Over the next 5-7 years, you buy 5-7 properties, you're doing just fine. Maybe each of those is a duplex or a triplex. Meanwhile, for the first while, you're living quite frugally and trying to save as much as you can, put all that
Mhm.
money into reinvesting in your portfolio. You don't have to be frugal forever, but I think frugality in the early stages is really important because every dollar matters so much more. That's when you're starting the compounding. So the more you start with, the larger the compounding effect is in the long run. So those early stages of people's investing journey, live frugally, house hack, um, first one 5% down, purchase plus improvements, and then the ones after that, good value add properties in a decent town, with a decent population that you feel good about owning the property for over the long run, and an exit strategy if needed. So ideally, try to buy under market value so that if you need to sell it, you can.
Fabulous. All right, Kellan, I know we started late. It's my fault.
No, no worries.
Thank you so much for your time. Yeah, if you want to come in next time, we could definitely do it in person. Because I'm sure Claire
Yeah,
would
absolutely.
like to say hi and shoot a YouTube with you.
I'd be happy to anytime. That sounds great.
Oh, and Kellan, you mentioned we haven't mentioned it on the show yet. You are currently doing a group coaching program
Yeah, yeah.
for 8 weeks, is it?
Yeah, I'm doing like an 8 week group coaching mastermind. So it starts on May 30th, 2023. And every Tuesday night at 7 p.m. for a couple of hours. It's all me, like doing like, I'm going to have some outside speakers, but it's going to be myself hosting it, walking through all of the steps for, not just basics of burring. There's going to be like beginner, intermediate, and some advanced stuff, scaling your portfolio, strategic renovations, creative financing, all of that stuff. So yeah, 8 weeks. It's on my website, kellanjames.ca. And that's where I also do one-on-one mentorship. One-on-one mentorship, I have to value my time. So it's quite expensive. It's mostly for intermediate to advanced investors who are looking to scale their portfolio and optimize it. It's a lot easier to help people in that space, right? It's when someone's got a few properties under their belt, you can have one call with them and save them 10 grand easily. If you're just like, oh, work with this lender or use this structure instead or whatever. So you can really provide good value to people who have portfolio to work with. So yeah,
Yeah, I was
those are the
talking to a
two.
novice investor who was trying to do a triplex conversion.
Yeah.
He's going to do a walkthrough with the contractor. I'm like, why don't you just check with the designer first if that property can be turned into a triplex? Why
Yep.
waste your time, and the contractor's time?
Yep. Exactly. And then maybe that saves them a couple of weeks of their time and they can put that towards some kind of better use.
Yeah, and not
Um,
lose the respect of the contractor.
yeah, exactly.
I
Exactly.
wasted all these hours of my time for a project that can't be done.
Yeah. No, I mean, like we've learned so many of these lessons over the years that it's so easy to just be like, here's what you should do. Here's the best use of your time right now. And oh, you're looking to make that decision. That's a good one. Or that's not a good decision. I'm going to suggest you don't do that and instead go do this. And if you compound that over, like my mentorship's 6 months and then there's extensions from there. So like, if you compound that over 6, 12 plus months, like you get some serious results with the right guidance. But you need an unbiased third party, right? There's very few people out there that you can get advice from that's going to be unbiased. But that's the whole point. What I do is to just like look at people's situations and go, what is the best thing you can work on right now, and have it so that they never have any questions. Because that's exactly what I wanted when I was investing in the early days. Is rather than ruminate and sit on wonder about this question for the next 2 weeks, I could just ask someone, they can answer it, and I can move on. Get a lot more done. Things move a lot faster.
I'll also add to the unbiased, you need qualified opinions as well.
Yeah.
I have a friend with a bit of a nightmare situation. They bought a property that has a ground floor commercial space, triplex with
Yeah.
ground floor commercial, right? So the property was reviewed. The mistake they made was that no one knew the area that well, so they didn't
Mm,
factor in the proper vacancy rate. So
yeah.
if that came across my desk, I would have said automatically it's gonna be 50% vacancy rate,
Yep. Exactly.
right? And
Yeah.
that would have killed the deal.
Yeah, exactly. I
Right.
always, for mixed use, I generally say that the residential portion of the building needs to support the building, and if the commercial could be vacant 100% of the time,
Yeah.
it still works. Then that works. Maybe that's overly conservative, but and that's probably what stopped me from buying any mixed use properties.
Yeah. If I showed you the property, you'd completely agree. You'd probably tell me use 80% vacancy rate.
Yeah, exactly. Yeah, yeah. I'm not a huge fan of mixed use, although I know investors that do quite well with it. One of my good friends, John Kepler, has quite a bit of mixed use stuff in Owen
Mhm.
Sound, so it can be done well
It
for
can be
sure.
done. It's gotta be right
Yeah,
area. It's gotta be in a high demand
yeah,
area. If it
yeah,
isn't,
yeah, exactly. Yeah,
yeah,
maybe like a plaza where you can get some chiropractors in there with recurring
yeah,
revenue and that
yeah,
sort of stuff. Yeah,
yeah. All right.
yeah.
Fabulous, Kellen. And then you have social medias as well. Where else can people follow you?
Yeah, Instagram, Kellan James, and my website, kellanjames.ca.
Fabulous. And then any final words? Because we're in a bit of a tricky market right now. Any final
Yeah.
words for anyone that's listening?
Well, people need to be honest about how it's harder to invest in the market right now. You don't want to be listening to people who are saying it's just the same, it's all the same, just keep buying and whatever. It's not about the raw mentality. It's make sure that you're buying solid deals, make sure you're forcing appreciation, make sure you have exit strategies. don't get crazy over leveraged. These are some good lessons to learn right now. When debt's cheap, take on more debt, and when debt's expensive, maybe pay off some of that debt. It sounds like common sense, but you'd be surprised how rare that is.
Yeah, common sense seems to go out the window when there's dollar signs in people's eyes.
Yeah, and exactly, the wrong incentives. Getting advice from people with the wrong incentives.
Kellan, thanks again so much for doing this.
No problem, Irvin. Thank you.
Thank you for watching. If you want to learn how to invest in real estate from scratch, my team teaches beginners how to use the #1 investment strategy that I personally use in a virtual free training class every month. Go to investortraining.ca/YouTube to register for our next class. The link's also in the description as well. I publish at least 2 to 3 videos a week here, so subscribe if you want to keep learning from seasoned investors like myself and my guests. And if you're just starting out, feel free to ask questions and comment below, and I do the best to answer each of those comments and questions myself. Again, if you're ready to learn the nitty-gritty about real estate investing from a professional investor, register for our next virtual class. That's at investortraining.ca/YouTube. Thanks again for watching. See you in the next video.